for Manufacturers, hosted by HBK Manufacturing Solutions, with special guests Al Schmidt, Brian Coddington, and Jordan Fazio from Source Advisors. Our session is scheduled for 60 minutes and is being recorded. Please note that all attendees are set up in listen-only mode. If you would like to submit a question to our panel, please use the question box in the GoToWebinar control bar. If we do not have time to answer your questions, someone will follow up with you by the end of the week. A copy of the presentation materials is available for download in the handout section of the GoToWebinar control bar. At the end of the session, you will be prompted to complete a survey and provide us feedback on the presentation. For more information and insights, please visit the Insights section of our manufacturing page. At this time, I'd like to turn it over to Amy.
Thanks so much, Lori, and thank you to everyone who has joined us today. Today is the next webinar in our HBK Manufacturing Solutions series, and we have a great webinar, great information planned for you today with our friends from Source Advisors. Source Advisors is one of our partners for specific tax credits and strategies such as Lipo inventory valuation and the R&D credit. Both of these areas can be used by manufacturers who may be looking to reduce or defer their legal tax liability. So we believe these are important strategies for all businesses, particularly manufacturers, to understand, even if you're not using them, just so that you can understand the potential benefits and whether it could be a fit for your business in the future. We're also seeing some conditions that make these strategies pretty favorable. For Lifo, for instance, we've all been witnessing the recent inflation, the costs of materials increasing, and those can make Lifo a valuable tool for certain manufacturers. In addition, with R&D, we're seeing an increase in research and development activities. We've seen some manufacturers take on new business lines, new customers, some of this resulting from some reshoring efforts, some of it relating to, new products that are being introduced. But in addition to that, we're also seeing manufacturers look at ways to reduce labor dependency, reduce costs, improve efficiencies, all things that at least should be discussed when looking at that R&D credit. So with that being said, I want to turn over the presentation to Al and the team from Source Advisors so that they can talk about these strategies in some more detail. Al?
Thanks, Amy and Lori. I'm Al Schmidt. I'm with Source Advisors, and I brought a couple of folks along with me to help out with some of the discussions, Jordan Fazio and Brian Coddington. So from an agenda perspective, as Amy mentioned, we'll talk about the research and development tax credit. We'll talk about LIFO as well. I put a lot of information in the slides, so you'll have that as a takeaway. We'll cover the information at a higher level with some of the things that a lot of companies that we talk to want to know about both the R&D tax credit and LIFO. And this does have it does qualify for those that want CPE. It does qualify. There will be some polling questions that we'll ask, and so be on the lookout for those. But from an R&D perspective, we'll talk about what is it, who and what qualify, the various industries that can qualify, some examples of the qualifying activity, and then we'll wrap it up with some of the things that you should be aware of and think of when looking at the credit. A lot of manufacturers can qualify and do qualify. It becomes a matter of how much in a lot of cases. And then the other thing, as Amy said, we're all well aware of the news just about every day talking about inflation. And so LIFO is, a lot of people are familiar with LIFO, but we'll talk a little bit more. It's become much more favorable given inflation and the significant inflation that we've seen. So what is it? Why now? Who can benefit? In a lot of the discussions, we talk about the IPIC methodology, or IPIC as some people refer to it. A lot of folks aren't aware of that and some of the details about that. So we'll talk about the IPIC method versus a traditional, or oftentimes we refer to as an internal method. and then some of the requirements to elect LIFO, and then some examples of some of the benefits. So just with Source Advisors, just to give you a little bit of background on us, we were originally formed in 1983 as Lipo Systems. We worked with auto dealerships and CPAs that work with auto dealerships to calculate LIFO, and so it was very niche. We got a very large share of that market, and in order to continue to grow, we needed to do something else. So we developed our IPIC LIFO service offering and worked primarily early on with PwC, Grant Thornton, and BDO, and then branched out and started taking that to all of our client base nationwide, many of them being CPA firms, to provide these very specialized areas of tax benefits. So, and then we started cost segregation about almost 20 years ago now. With that, there's 179D, which is energy efficiency, and 45L, which is also energy efficiency. One's a deduction, one's a credit, and then the R&D tax credit we brought on as well. So really all of these services can help reduce tax liability. So, and with that, we have our first polling question.
Oh, and I can read that there. How much experience do you have in R&D? Just feel free to select the one that's most applicable there. I can't wait to find out what the R stands for. I know enough to be dangerous, or I annually participate in my company's R&D study.
So with the R&D credit, the R&D credit has been around for a long time. So it originally was developed with the hopes that companies based in the U.S. would invest in innovation, basically to keep manufacturing in the United States as opposed to going offshore. And as Amy mentioned earlier, there has been some reshoring. Ohio had a great win with Intel and chips. Most of the chips have been produced outside of the country. Intel will now be developing those onshore, so they will be able to take advantage of the R&D credit from that perspective. I'm sure they are taking advantage of the R&D credit already in some respects. But the credit has been around for quite some time, and it has evolved over time. Most of the time, it has really been something, until as of late, it really was something that was a political bargaining chip, and it was renewed on an annual basis. Sometimes it took a little longer, and it was retroactive. But it has improved and become more applicable and more beneficial to a lot more companies. And it became permanent with the PACT Act, the PATH Act in 2016, which was great for a lot of folks because they could now budget it into their plan as opposed to hoping that it got renewed each and every year. And then with the TCJA, they didn't change it very much, but it did become more valuable in some respects as well. So with R&D, it is a very broad definition, which the qualification is really the 4-part test. And with the 4-part test, a lot of folks think it's I don't have anybody with white lab coats running around. You could hit the next slide there for me real quick. A lot of folks think I don't have anybody with white lab coats running around, so I don't really qualify for R&D. But R&D really is a very broad definition, and a lot of folks certainly can qualify. So, or if you could hit the next slide there. Thank you. So the four-part test, it really is a four-part test. You have to qualify for all four parts. It's not 1 out of 4, 2 out of 4, 3 out of 4. It's all four. If you don't hit all four, then you don't qualify for R&D. So the four-part test is the main part of it. There is something we'll talk a little bit later about, which is rights and risk, which can also come into play. I think a lot of companies don't often think about the rights and risk. They just think about the four-part test, but it is something that can potentially disqualify them. Again, we'll cover that later. But you got the first two, which are usually fairly easy for most companies to say they meet those tests. The first one is permitted purpose, which is really, are you making a new product or process, or are you improving an existing product or process? Said another way, are you trying to make something faster, better, cheaper, safer, more reliable, etc.? And most manufacturers are continuously trying to do that. Otherwise, there will be a point in time where they will no longer be in business. So permitted purpose is the first test. Technological in nature, a lot of manufacturers hit at least one of that, if not multiple, which is really just using the hard sciences, if you will. A lot of folks use CAD design or computer sciences. Certainly biological and physical sciences and engineering come into play there too with manufacturing in a lot of cases. So the other two kind of go hand in hand. There's elimination of uncertainty, which is really a customer may come to you and say, hey, you have product A, but I need something that does something a little bit different. Maybe it needs to deal with extreme heats, which your current product doesn't deal with. So you've got to figure out a way to try and do that. You may not know how you're going to do that at all. You may know that you can do it. You just don't know how you're going to do that. And then figuring out how you're going to do that is really the process of experimentation. So being able to go through that experimentation and design and trying to test it and make sure that it works as the customer requires it to. So that could involve CAD design. That could be as simple as having various discussions about the different things that you might use. Could be some testing as well. Could be prototyping and things like that. So. And then we'll touch a little bit more on the qualified research expenses on the next slide. There's really three components that make up the QREs, as they call it, or the qualifying research expenditures. Wages tend to be the largest amount from a QRE perspective. And it's W-2 Box 1 wages, and it can involve direct, supervisory, and support, which we'll get into in one of the next slides. But supply costs certainly can apply, and some manufacturers have a lot of supply costs. Some of them don't have a whole lot. So it just depends on your particular business. And then certainly contractor costs can come into play as well. In the current environment that we're in, you just may need bodies, and subcontracting that out to get additional folks to be able to participate in the research and development activities that your employees are involved in. Or there may be some particular component that you don't have the internal expertise, so you have to hire that out to make sure that you can have somebody figure out what you're trying to figure out. So those are the three main components: the wages, supply costs, and contractor costs. There can be some computer related. We'll touch on that with software in some of the future slides, but that potentially can qualify. A lot of folks like to know, what does it really mean? You have a net credit, really, from a QRE perspective, that the amount of money that does qualify usually ends up being 7 to 10% of those expenses is what the net credit works out to be. So, if you have $1 million in QREs, it could be a $70,000 to $100,000 net credit potential. Those credits can be carried back 1 year and carried forward 20 years. And you also have the ability, if you haven't taken the credit before, you have the ability to look at the current year and the 3 open years prior. So with the R&D life cycle, we touched on this a little bit with the last slide. It's direct research, it's technical support of those direct research folks, and supervision. So oftentimes it might start with sales and marketing that are talking to customers or prospects, and they say, hey, this is something that I need. You don't currently have that. I can't really find it anywhere else. Is this something that you can make? And folks would say, sure, I think we can do that. That goes into research and conceptual design, then goes into design and engineering. You might make some prototypes or samples out of that. And then you get into testing and validation to make sure that you can move it on to production. You may go from testing and circle back around and go through that process again before you get to production. Could be multiple times even. But then eventually you get to production for that particular product. And once you reach production, R&D tends to cease, at least as it relates to the product. However, there are things that from a production perspective can still qualify, which are really based on the process. So you can do various things to improve that process with the production line that can potentially qualify. So Jordan, I don't know if you want to add anything to that.
Yeah, I think, the obvious here is the green boxes are where we typically find R&D activities, right? And the real intent of this slide is really to illustrate, I think it's obvious to most people, the folks in the white lab coats, the engineers, the computer scientists sitting in a room, writing code, coming up with formulas, designing new products. That's our direct research and development. Very, very clean cut and obvious. But the real point of this is to show the birth of the credit, right? And show how many more individuals beyond that really are involved in the process and can qualify for the credit. Finding that core R&D is key, but understanding how to feather out and incorporate all the individuals actually touching it, even if it's just a small amount of their time, is what tends to lend to the better benefit, of course, and the more accurate R&D tax credit.
Thanks, Jordan. And that'll actually take us to the next polling question.
Okay, when do qualified research activities typically stop in the R&D life cycle? Is it once a prototype has been built, after final testing and validation, at the start of commercial production, or once the product is being marketed and sold?
There are a lot of industries that can qualify. I think there's really probably 3 buckets that we typically look at, and mostly 2 as of right now. It really becomes a discussion around manufacturing, which a lot of these various industries touch manufacturing, and then software development. And there are a lot of industries that people don't normally think about that can claim the credit, and that's really because of the software development. So a lot of folks typically think about Oracle, SAP, Microsoft when it comes to software development and the research and development tax credit. But we've actually had some manufacturing companies. We've had some on the software side, some banks, financial institutions, hedge funds. Everything that they're doing is actually developing software internally. And if it's something that is not commercially available, then certainly they develop that internally, as opposed to a lot of manufacturers. When we're talking about R&D, they'll say, well, I just bought a new ERP system, and we're putting a lot of money and effort into that and trying to make all the systems talk to each other, et cetera, et cetera. So ERP systems are typically owned by someone else, and a lot of the work that's done with those ERP systems doesn't tend to qualify. CRMs are pretty much the same as well, but a lot of the manufacturing that you're doing, again, making something faster, better, cheaper, safer, more reliable, that does qualify in a lot of these various industries, all related to manufacturing. So. There's the next slide really talks about some of the case studies, and these are really more examples than case studies. And one thing that I think is really interesting to point out is there really is not a correlation between revenue or sales or anything to that perspective. It really is about the people that are doing the work and the type of work that's being done. So, you see the first one there, which is telecom. They only have 10 million in sales relative to the heavy equipment manufacturing, which has 10 times the amount of sales. But the telecom has a credit that's $1 million versus $500,000 for the heavy equipment manufacturer. So again, there's not really a correlation between sales that you can draw. It really is about the people and the activity. So, as you can see, there is a pretty good variation from a $2 million company all the way to a $390 million company, and 150, 120,000 all the way up to 1.6 million in a credit. So certainly these credits were meaningful to each and every one of these at the level that the credit was. So it just certainly depends on the activity and the wages and the amount of the credit as to whether or not it makes sense for the individual companies. And then we have a more detailed case study that gets into a little bit more of the facts and circumstances. Jordan, if you want to.
Yeah, sure. And, absolutely. And I'll spare everyone reading every word on this slide and just kind of give you a high-level synopsis. So again, manufacturing client, they happen to be in the food and beverage industry, right? Manufacturing candy. So this particular example we wanted to highlight was for a project that qualified in their R&D study, targeting a special container to hold gumballs. The target audience for this particular product was children. So, understanding the fit and feel and form and function for that container for the intended audience was very important. Identifying the right combination of materials was greatly uncertain through the process. So they needed value engineering to an extent, right? These couldn't be really expensive, highly engineered pieces, but they also needed to be able to withstand shipping, being stored for months on end, and then actually the end users, the small child's hands, right? I have young children, they're not easy on anything. So a lot of iterative testing and design went into the actual container for something as simple as gumballs, right? Again, we had end user testing, we have engineering testing going on. We had a series of different designs, changes in design through the process of experimentation. All in, equating to roughly $750,000 of R&D tax credits when we look across the entire portfolio of projects across the years. Now, this one example is just designing a container for these gumballs, right? But I think it's pretty easy to extrapolate from there. Anytime we're making a new product, odds are we're going to have these technical uncertainties. Odds are we're going to have to do some of this figuring out, right? Cases where this wouldn't work out, if we were more on the contract manufacturing side of things and client was bringing to us a ready-baked specification, print this part to my specification. That wouldn't so much meet the mark, right? But certainly in this example, every internal product they were making required this design of packaging. And oftentimes in the food and beverage industry, the packaging does become the larger part of the research and development exercise. Certainly formulations and understanding the different raw goods coming in and how we need to tweak the process of getting them through manufacturing is a part of it and does bolster the credit. But interestingly enough, a lot of the R&D in this regard was focused on the packaging, shelf life, and the end user's intended use.
Thanks, Jordan. A lot of what we've talked about so far has really been about the federal credit. There are state credits that are available as well. Not every state has a credit, but a lot of them do. Some follow. A lot of them follow the federal guidelines. And some states are certainly much more valuable than other states. So it is something to certainly think about and look at and take into consideration. One point to certainly make is if you have business that you're doing in multiple states, locations, if you will, and it's just sales and marketing or distribution in another state, then that more than likely would not qualify for R&D, although some salespeople can, but it would really be the technical folks or the support folks that are involved and are living in that state where they would be able to take the credit from that state perspective. So there are qualifying activities. I've listed a bunch of these here. I'm not going to go over a bunch of them. You do have this as a takeaway just to see that, but there are, if you're developing any second generation or improved products, if you're dealing with any tooling, equipment, fixture design and development, if you're designing manufacturing equipment, perhaps they don't have anything that you can purchase, or maybe you purchase something and it doesn't fit your needs, so you got to do some significant modification to meet your specific needs. Some of those things can certainly qualify. There's alternative material. There's a lot of that, especially as of late. People can't get certain types of products, so they have to try and make things out of other products, and that can require a lot of research and development, really. And then streamlining the manufacturing process through automation is another area that can certainly come into play. So the next slide deals with activities related to software. So I thought this was at least good to see. A lot of manufacturing companies may not be developing any software in-house. Sometimes there are some, but I thought it would be good to at least have this in there so you know what could qualify from a software perspective. So.
In general rule of thumb on that, and it plays right into this slide, so that's perfect. General rule of thumb on software: if we have a software project that we're considering for R&D, generally speaking, it's going to need to be proprietary software that you're building internally. Al touched on this earlier. Implementation of third-party softwares doesn't really hit the mark. It's not going to qualify. Furthermore, a little near the bottom here, we have this funded research bullet. Funded research is an important part of this, right? It's part of Code Section 41. What funded research means is that you carry the financial risk behind the development, as well as retain at least substantial rights to the IP behind the development. And that third-party software, that's exactly how it gets weeded out, right? When we're implementing Salesforce and we're implementing a new ERP, whether it's from Oracle or whomever, they own the rights to that software. So we're not actually allowed to claim any research and development tax credits associated with implementation of someone else's IP. Likewise, we talked about having third-party contractors includable in the study. It's important to understand that relationship and who carries the financial risk as well as the rights to whatever's being developed. So if we have a 1099 contractor we bring in to do some type of specialized testing for us, we have to be paying them, one, on a time and materials basis. This is to show that we have the financial risk. If it takes 100 times longer than that 1099 contractor initially estimated to do the work, the financial overage is on the company paying the 1099 contractor. If it was a fixed fee engagement with that contractor, we wouldn't be able to include it because the IRS does not view you as having the financial risk behind it. Likewise, you would need to retain all IP behind the work the contractor was doing. If they had some special IP provision in their contract that they were allowed to keep and reuse any IP they discovered while working for you, it again would be not considered admissible. Usability, usually a pretty big key for these research and development tax credits. In certain cases, for startups, small entities that just began, you can use these credits to offset the payroll taxes on an annual basis. However, that's pretty few and far between, and I'm guessing that's probably not our audience today here. For the federal credits, you really need to be paying federal income tax in order to take advantage of the credit. There is a long road for usability. They are carried back 1 year if there's no usability in the current year, and forward up to 20. But always a key aspect of this exercise, if we think we have R&D credits, making sure that we're going to be able to use them on our return. Controlled groups, again, we won't hit this too hard, but just know that control group definition is common control of greater than 50% for R&D purposes. So if there is common ownership amongst multiple entities, we do have to evaluate them as a single entity, and the credit gets allocated out to the various entities on a ratio of expenses. Passive shareholders, for pass-throughs, there can be a negative impact to passive shareholders if you are claiming the credit. This has become less of an issue since the TCJA. A lot of AMTI limits were increased. Likewise, we just find fewer and fewer clients in an AMT situation, but it is something that should be looked at again at the onset when you're evaluating whether or not you should claim these credits, just to fully understand if any of our ownership is going to be negatively impacted by the credit. And finally, documentation. We haven't touched on this much, but documentation is critical to be able to defend these credits should they come under audit with the IRS. Now, a lot of documentation through our services we can help create, right? We can do oral testimony, we can create long written narratives, but at the end of the day, the more physical documents, engineering drawings, project plans, meeting notes that we're saving, it's just going to be more beneficial should you ever have to justify or substantiate these claims with the IRS.
Thanks, Jordan. And really, to summarize the R&D, it's been around for quite some time. Hopefully, some of you are taking advantage of that, which is fantastic. If you're not taking advantage of it, it's certainly something that is a good thing to look into. Even if you looked into it 3, 4, 5 years ago, maybe 10 years ago, there have been a lot of changes. Your business may have changed as well, and there may be some activity that qualifies. So being able to look at that and quantify, what that is, what that credit is, to see whether or not it's valuable for you and the organization. So, and then with that, we'll transition into LIFO. So, I think there's certainly a lot of interest in LIFO given the current environment and the inflation. We've done LIFO for a very long time. From say 2009 to 2016, we didn't even talk about LIFO all that much. But with 17 through 20, there were certainly pockets of some fairly significant inflation. And then in 21, I don't know that there's too many industries at all that haven't seen significant inflation. And we've looked at a lot of them for the 2021 tax year. So what is LIFO? I think a lot of people probably generally have an idea of what LIFO is. But for the most part, it's not a physical type of thing. It's really an accounting methodology. It really helps lessen the impact of inflation and therefore provides a tax benefit that can be an indefinite income deferral until you actually sell your business. And so we touched a little bit on why LIFO, why now. Inflation is back in 2021, and it's back with a vengeance. We've seen a couple of companies that had 150, even 200% overall inflation in their inventory. So, with that amount of inflation, inventory tends to be one of the largest assets for most companies. So it can be a really good way to help increase the cash flow for the company from a tax benefit perspective. So there has been discussions of doing away with LIFO over probably the last 20 years or so. I won't go too far into that because there haven't been a whole lot of discussions as of late with the TCJA and beyond. there hasn't really been much of a discussion there, and the TCJA was probably the best opportunity for them to potentially do away with LIFO. But there are a lot of industries, a lot of metals, plastics, auto dealerships are huge, grocery stores. So there are a lot of companies that are on LIFO, and repealing it would have a significant impact on a lot of companies and industries. So the LIFO adjustment is really a year-end adjustment. It shouldn't impact the day-to-day, month-to-month, quarter-to-quarter in any way. And really, from an adoption perspective and ongoing calculation, I think a lot of companies like LIFO. They don't necessarily like doing LIFO, so that's really where we've come into play, and we try to make it as easy as possible for folks to be able to take advantage of LIFO, but also not have to do it. So, and candidates for LIFO, really, just about any company that's on LIFO can be a very good opportunity to move to the IPIC method, which we'll get into here in the next couple of slides. But anybody that's on LIFO and not using the IPIC method should at least look at the IPIC method to see if there's a better benefit. Oftentimes there is. Even folks that are on the IPIC method, there might be some things that can be changed and can be more beneficial and should potentially be looked at. But any company that's not currently using LIFO, and they have at least 2 million in inventory or more. The more inventory, the better, and we'll talk about that as well in a future slide. Should at least consider it. And then profitability, certainly just about everything that we do, really you have to be profitable in paying taxes. And then inflationary in their industry, and I'll caveat that by saying, as it relates to their internal inflation, the IPIC methodology oftentimes can show inflation when folks aren't experiencing inflation from their actual cost, and we'll talk a little bit more about that. So, some of the common misconceptions, Brian, if you can jump in and talk about that, that'd be great.
Sure, thank you, Al. So, when it comes to LIFO, there are a lot of issues that come up very often, and one of the ones that we don't see so much anymore, but it used to be a big issue, is people thought that their inventory turned too often for LIFO to work. This is really more of a mistake of looking at LIFO as an actual, what's actually happening in your physical inventory compared to it being a cost flow assumption. And in general, most people understand that's just a cost flow assumption. It's about comparing cost at a certain point with costs from prior years to calculate an inflation index. The most extreme example I've ever seen was a convenience store that their inventory turned daily. And it turned so often that when the IRS audited them, they looked at their unit cap, their additional tax costs that they had to capitalize, and they didn't have any. And the IRS said, well, I mean, your inventory turns daily. We're not even going to bother with that. It's not material. So inventory turns are not an issue. One thing where there can be some issues are bankers may not understand the financial statement impact. LIFO has a conformity requirement. If you use it for tax purposes, you have to use it for financial reporting purposes, not just in a 10K, but also in financial statements that are issued annually. At least once a year, there have to be adjustments to bank statements that are issued monthly or quarterly. So bankers definitely want to need to be part of the discussion early on if you're looking to go to LIFO. You have to address debt covenant issues. You have to make sure that they're on board with how your financials are going to be presented, because you can't use, generally speaking, a FIFO basis on the face of your income statement. You can disclose that in footnotes or supplementary info, but it's not, some banks have trouble understanding. But, historically, and even currently, I've never seen it be a roadblock. Banks run their own analytics and they just get it back to FIFO anyway. So what if inflation goes away? In general, economy-wide, we have had inflation in the United States since the 1930s, with minor exceptions here and there. In some industries, we saw some deflation, in the 90s to say 2008 time period, especially with electronics. In economy-wide, I think the last big dip into deflation was maybe 1956. So if you look at any 5 or 10-year period, even if you deal in commodities like steel where prices can swing wildly, then, over a 5 or 10-year period, picked at random, you're going to do better on LIFO compared to other inventory methods. You're going to come out ahead for tax purposes. Now, one issue that we didn't pay a lot of attention to up until last year, because it never affected that many companies. What if your inventory levels drop precipitously? And last year, that actually happened industry-wide to the auto dealership world. August, July of last year, we started getting calls and dealerships would say, hey, we have no cars on our lots. What's going to happen to LIFO? Oh yeah, and we aren't going to get any more by year end. Well, that is a once in a lifetime issue. There hasn't been economy-wide or industry-wide, there hasn't usually been that kind of shortage for anyone since maybe 1970s with oil embargoes, but definitely World War II. That was the last time we really dealt with shortages like that. And generally speaking, and talking to companies across industries across the US, that's going away. And finally, once you're on LIFO, do you have to stay on it? And the answer is yes, but it depends. So you can elect to be on LIFO for tax purposes and for book purposes too. The IRS allows you to get off automatically, just with filing a certain form with your return after 5 years. Don't have to pay the IRS a user fee. They don't have to approve it. So generally, we look at LIFO as a 5-year commitment. However, for good reasons, the IRS may permit a taxpayer to submit a manual accounting method change, is what they call it. They submit a form to the IRS in Washington, D.C., pay them a $11,500 user fee, and they'll review the facts and circumstances to determine if someone can go off LIFO before 5 years are up. It does happen. Historically, the IRS has permitted that. It's very rare, though, that those types of situations come up because LIFO tends to be beneficial. So moving on to the next slide.
That actually brings us to the next polling question.
Awesome. So what does LIFO stand for? Luckily, I'm flying out. Last in, first out. Last in, forgot offer. And liner in, free out. And technically, there are 2 correct answers. Though I wouldn't expect the second answer to be very familiar to people. All right.
Well, yeah, go ahead.
Oh, sorry. I think that takes it back to you, Al.
Thanks. So here's some examples of folks that have actually elected LIFO in the 2020 year. Just a few things to point out. The inventory levels are kind of all over the board. So you've got folks with 2.6 million, 3 million, 4 million, all the way up to 31 million. And the inflation tends to be the main driving factor, but also the inventory levels. So you've got 120% inflation with the building products manufacturer that only had $3 million. But that produced a $1.75 million LIFO reserve, which is a pretty significant tax savings. Then you have the $31 million company that 30% inflation produced a $7 million LIFO reserve, so pretty significant tax savings there. So this just gives you a little bit of an idea of the various folks that have elected this past year in manufacturing and distribution mainly. So I mentioned earlier the different methodologies. So there's the IPIC method, or IPIC as some people call it. There's inventory price index computation is what that stands for. The other is a traditional LIFO method. Oftentimes we refer to that as internal. IPIC we sometimes refer to as external, in case I say that and don't clarify that. So the traditional methods can really, there's a lot of different ways that you can come up with your internal index. And because of that, the Treasury wanted to come up with something that was easier. So they came up with the IPIC methodology, and it uses the PPI or CPI to come up with your inflation. The CPI can be used by retailers. They can also use the PPI. Everybody else really uses the PPI, the Producer Price Index. So it's a U.S. average, and it may or may not reflect actual inflation that you might be seeing. Oftentimes, the IPIC methodology shows quite a bit more inflation compared to what people are typically seeing. So most years, we always suggest that folks should look at or consider both. In 2021, it was more important to really consider both. IPIC was still by far the better answer from a tax perspective in most cases, although we did see some where the traditional or internal method did show higher inflation. So looking at the IPIC methodology a little bit deeper, it has the potential for a better tax benefit than an internal methodology. Oftentimes it is better, not always, but in a lot of cases. There's simplicity, which is why the Treasury came up with it in the first place. Is it provides simplicity over internal index, because there are, again, a lot of different ways that can come up. That you can come up with that index. So for those folks that are on LIFO using an internal methodology, the Treasury, in order to get them over to the IPIC methodology, they offer audit protection. So they would prefer that folks are on the IPIC methodology because it's easier for them to audit. So they do offer audit protection. Now, the IPIC methodology, there's a lot more to it that we're really not digging into. But if we look at the next slide, it really shows the sub-methodologies. If you look at an internal methodology or traditional methodology, it's basically your year beginning and your ending actual cost, and that's your inflation factor. With the IPIC methodology, there's a bunch of sub-methodologies that they allow you to use within the regulations that can really provide some significant benefits over and above what really it's options, and you can choose those options. So a lot of folks looking at this slide, this is an actual estimate that we did for a client, and it really shows the power of the IPIC methodology to maximize the tax benefit. Most companies probably would have looked at December and said, hey, we've got a $280,000 LIFO reserve. That's a great reserve. We're happy with that. But if you look at some of the options available under the IPIC method, really the with grouping, which is a sub-methodology, preliminary numbers in October produces a better answer. So it's $623,000 LIFO reserve, which is more than double what they would have got if they just looked at December as an example. So this is really just an illustration that shows the power of the IPIC methodology, or the potential of the IPIC methodology to maximize the tax benefit. So I know we didn't go into a lot of the sub-methodologies and various options there, but there is quite a bit of flexibility within the IPIC methodology to be able to do that, and certainly something that we can help with talking through that. with the next slide, it talks about the traditional methodology or internal methodology, and it really again measures your year beginning and your year ending actual cost. What did you buy the item for at year beginning, and what did you buy it for at year ending? And that's how you come up with your inflationary factor. There can be a lot of different variations to that, and certainly, Brian, if you want to add to that as far as maybe elaborating on some of the variations and anything else you want to add to that slide. Brian, did we lose you?
Oh, sorry. I was muted. If you're familiar with LIFO, it's probably a traditional LIFO method. This is what most companies that come to us already on LIFO are using. And it is based on your internal costs. How those costs are determined, there are a wide variety of direct and shortcut methods, how those are determined from different points in the year, using different methodologies. And overall, the big weaknesses in traditional LIFO are, one, documentation for those earlier costs. They often just don't exist anymore, especially if you've been on LIFO since the 70s or 80s. Even the 90s can be hard. Then there's also a lot of item definition, a lot of pooling issues, and these are all concepts that the IPIC method is addressed to remove that kind of controversy with the IRS. Now, traditional LIFO methods can give you a much better result. We've seen that a lot in the steel industry where, about half of the new steel companies that elected LIFO this year, half used IPIC, half used their own internal costs. And it's really all about their product mix and what they have in inventory. And the ones that were getting 300% inflation, well, those usually were, using their own internal costs. The ones who were looking at 100% inflation, well, those were usually on IPIC. And even there's wide variability just depending on what each client had, what their specific inventory mix was, and where they were in the production chain, whether they were a machine shop or a manufacturer of steel products, of steel itself. So definitely a great idea, and we always look at it when we look at IPIC, but it can be more complicated and invite more controversy with the IRS. So moving on to the next slide.
Thanks, Brian. So some of the advantages of a traditional LIFO method, really, we saw this some in 2021, especially, where when there's quick, significant spikes in inflation with the products that you're purchasing, sometimes that takes some time to get into the PPI, if you will. So it can be a better tax answer in those situations sometimes. And eventually, IPIC is oftentimes more advantageous, so you can switch automatically from a traditional or internal method to the IPIC method if and when it becomes significantly better. The disadvantages from a traditional perspective is really when we use the grocery industry a lot as examples. When you're looking at item definition, you got to compare the item to the identical items. So if you think about milk, you got 1% milk, 2% milk, whole milk. And if you only have whole milk in your inventory and then you purchase 1% milk to sell, then that is technically considered a new item, and a new item within that year gets a 0% inflation factor if you didn't have that at your beginning. Now you can try and reconstruct that, but that can oftentimes be fairly challenging. So those are some of the some of the issues that you have from a LIFO perspective when it becomes, we're talking about a traditional method. The IPIC method doesn't have an issue from an item definition perspective. So you're able to take advantage of that 1% milk that I just mentioned under the IPIC methodology and whatever that related inflation is under the PPI. So or CPI. So that can actually be a good thing. So requirements for LIFO, and I know we're coming up on the hour here, so we'll run through the next couple of slides fairly quickly. Requirements for LIFO, you have to do a Form 970 to elect LIFO. If you're on LIFO, it actually is a 970 and a 3115 to move to the IPIC methodology. As mentioned earlier, there is a conformity requirement. What you do for tax, you have to do for book. You don't necessarily have to use the same methodology for book and tax. A lot of folks do, but a lot of folks, other folks will look at a different methodology for book purposes, oftentimes to try and minimize that impact. And then lower of cost of market is something that if you elect LIFO, you're not able to use lower of cost or market. So that has to be brought back into income over a 3-year period. With that, we've got our fourth polling question.
If a taxpayer adopts LIFO, which is not true, you also have to use LIFO for financial reporting, can use different book tax LIFO methods. You can't change non-automatically for 5 years. You can't change automatically from LIFO for 5 years. And we'll give you a second to get that final answer.
So this slide is there as a takeaway. I think it's a good cheat sheet, if you will. A lot of folks will ask you what might the benefits look like. So for those folks that have higher inventory, $10 to $20 million, you don't need as much inflation for it to be a beneficial thing for you. But the lower inventory that you have, the higher the inflation needs to be to see some sort of benefit there. So this is at least a good cheat sheet to say, hey, if I've got 5 million inventory and I think it might be 10% inflation, what might I be looking at from a benefits perspective? So that's always a good one to reference. And in summary, LIFO is certainly a good thing to look at, especially in a time of high inflation. It can produce some pretty significant tax benefits that can certainly grow over time. So, it is an annual calculation that doesn't impact day to day, and it should be a minimal investment from an adoption and ongoing calculation for that. So, and certainly analyzing internal as well as the IPIC methodology initially to see what the better tax benefit might be. So, the next couple of slides really are just the bios. I guess we got a quick poll there.
Al, we had a little issue with that poll. So if you require CPE credits for today's session, just make sure you fill out the survey and in the notes section, make a note that you would like to have CPE credits.
Okay. Well, the next couple of slides are really just the bio for myself, Jordan, and Brian, and then there's a Q&A slide, and then there's just contact information. So, if you have any questions, I'm happy to address them. Jim DeCenzo, who heads up the manufacturing group for HBK, is certainly available as well to answer any questions that you might have. So we certainly appreciate the time and the opportunity. And Lori, I think that probably goes back to you.
Great. Thanks, guys. I just wanted to thank Brian, Al, and Jordan for today's insights, and thank everyone for attending. Again, please make sure to complete our survey at the end of the session to provide us feedback for future webinars or to let us know if you needed credits for today's session. And if you had additional questions, you can submit them in the survey, or you can go to our website at hbkcpa.com. Thanks again for attending today's session, and we look forward to hearing from you.